3.2 trillion, that's the current size of foreign exchange reserves held by China. A number so large it feels abstract until you remember what it represents. Actual US Treasury bonds, euro-denominated assets, gold bars locked in vaults, and claims on the future purchasing power of entire nations. While the news focused on inflation, elections, and stock market rallies, the real money was doing something else. It was repositioning for the long term. Not dramatically, not in a single crash, but quietly, year after year, away from a single center of gravity. While the news focused on rate cuts and tech stocks, the real money was doing long-term risk management. And that shift, slow as it looks on paper, is what will determine whether your savings compound or decay over the next decade. Because this story isn't about a sudden collapse of the dollar. It's about something more subtle and far more important. It's about the gradual erosion of monopoly. For 70 years, the US dollar has been the default operating system of global finance. Oil is priced in dollars, trade is settled in dollars, debt is issued in dollars, central banks hold dollars because everyone else holds dollars. This creates a self-reinforcing loop known as network effects. The more people use the dollar, the more valuable it becomes to keep using it. This is why previous predictions of the dollar's demise failed. The system is deep, liquid, legally protected, and historically resilient. It has the world's largest bond market, the most sophisticated financial infrastructure, and the strongest institutional framework. But network effects don't make a system immortal. They just make it sticky. And sticky systems fail slowly, then suddenly. The real pressure point isn't BRICS. It's the bond market, specifically the US Treasury market. At over $34 trillion in outstanding debt, US Treasuries are no longer just government bonds. They are the foundation layer of the global financial system. Banks use them as collateral. Hedge funds use them for leverage. Central banks use them as reserves. The repo market, where trillions of dollars in short-term lending occur every day, runs almost entirely on treasuries. This only works if treasuries are treated as risk-free. Not politically risk-free, not morally risk-free, financially risk-free, meaning low inflation, stable purchasing power, and predictable real returns. That assumption is now under strain. Not because the US will default, but because the US has entered a structural regime of permanent deficits. In the 1980s, US federal debt was about 30% of GDP. After the 2008 financial crisis, it crossed 60%. After COVID, it exceeded 120%. And unlike past cycles, this debt is no longer tied to temporary emergencies. It's embedded into the operating model of the state. An aging population means rising entitlement spending. Healthcare costs grow faster than GDP. Defense spending remains structurally high. Interest payments compound on top of everything else. The system now requires continuous borrowing just to function, which means the supply of treasuries must keep growing, but demand doesn't have to. This is where the mechanics matter. When a government issues too much debt, yields should rise. When yields rise, interest costs explode. When interest costs explode, the political system intervenes, not secretly but publicly, through quantitative easing, through balance sheet expansion, through regulatory pressure on banks, through rate suppression. This is not a conspiracy, it's accounting. The Federal Reserve doesn't manipulate markets in the shadows. It stabilizes them in the open. But the effect is the same. The largest buyer of US government debt is increasingly the US financial system itself. In technical language, this is called financial repression. In plain language, it means the system survives by diluting existing holders. Not through default, but through inflation. This is the invisible tax. And this is where the global shift begins. Central banks don't care about ideology. They care about purchasing power. If holding treasuries means accepting negative real yields, meaning your returns are lower than inflation, then treasuries stop being a store of value and become a guaranteed loss. So central banks start diversifying. Not abandoning, not panicking, diversifying. Reducing marginal exposure to dollars, increasing exposure to gold, increasing bilateral trade in local currencies, building parallel settlement systems. This is what de-dollarization actually is. Not the collapse of the dollar, but the end of its exclusivity. China reduces the share of dollars in its reserves. Russia prices energy outside the dollar system. Brazil and Argentina settle trade in yuan. India builds alternative payment rails. Middle Eastern exporters explore non-dollar invoicing, not to destroy the dollar, but to hedge against it. And that distinction matters. Because the biggest risk to the dollar is not replacement, it's optionality. For most of modern history, if you wanted to trade globally, you had to use dollars. Now you don't always have to. That's the shift. To understand where this ends, we have to look at 1971. August 15th, 1971, the Nixon shock. The United States suspends gold convertibility and the Bretton Woods system collapses. The dollar becomes a pure fiat currency. Before 1971, dollars were claims on gold. After 1971, dollars were claims on future taxation, on the productive capacity and political will of the American state. This gave the U.S. extraordinary flexibility. It could issue unlimited currency without losing formal backing. It could finance wars, social programs, and deficits without immediate constraint. But it also created a new kind of risk. A currency backed by nothing except trust must continuously earn that trust, not through rhetoric, but through discipline. Low inflation, predictable policy, stable debt trajectories, credible institutions. For decades, the US managed this well enough. Inflation was episodic, growth was strong, treasuries paid real returns. Holding dollars was not just convenient, it was rational. But in the last 20 years, something changed. Debt stopped being cyclical, it became structural. And once debt becomes structural, inflation becomes political. Because raising rates to control inflation increases interest costs. Higher interest costs increase deficits. Higher deficits require more borrowing. More borrowing puts pressure on yields, and higher yields destabilize the entire system. So central banks face a choice. Protect the currency or protect the system. They always choose the system, which means real returns get sacrificed. This is why gold was reclassified as a Tier 1 asset under Basel III, not because banks expect collapse, but because regulators expect monetary stress. Gold has no counterparty risk, no default risk, no yield, but no dilution. It's not a doomsday asset, it's an insurance asset. And central banks have been accumulating it at the fastest pace since the 1960s, not replacing dollars, but complementing them. This is the pattern that repeats across history, not collapse, transition. The Dutch guilder didn't vanish overnight. It lost relevance over a century. The British pound didn't implode. It gradually ceded dominance after World War II. Even the Roman denarius didn't fail in a single moment. It was slowly debased until no one trusted it. The common thread is not catastrophe. It's arithmetic. When claims grow faster than productive capacity, the currency adjusts, not through headlines, but through purchasing power. This is why most people misunderstand monetary decline. They expect a crash. What they get is drift. Your bank account still shows numbers, your salary still arrives, your investments still fluctuate, but the unit itself is shrinking. You don't notice when money is failing. You only notice when everything else gets expensive. Food, energy, housing, insurance, education. Not because these things become scarce, but because the currency measuring them becomes less valuable. This is the real wealth transfer. Not from rich to poor, not from west to east, but from savers to debtors, from wage earners to asset holders, from fixed incomes to flexible capital. This is what financial repression actually does. It rewards leverage. It punishes liquidity. It makes debt rational and cash irrational. And this is why the next 12 to 24 months matter. Not because the dollar will collapse, but because the macro regime is shifting. If central banks continue suppressing yields to finance deficits, real returns will stay negative. If inflation remains structurally higher than interest rates, cash will mathematically lose value. If governments continue running persistent deficits, monetary policy will remain trapped between inflation and instability. If central banks keep diversifying reserves, dollar dominance will weaken at the margins. None of these require a crisis. They only require continuation. And continuation is the most likely scenario. The unprepared respond emotionally. They chase yield. They speculate. They hold cash waiting for crashes. They react to headlines. The prepared respond structurally. They hold assets with pricing power. They minimize exposure to long-duration debt. They understand inflation as a tax. They think in real terms, not nominal ones. Because when currencies drift, not collapse, the winners are not the ones who predicted the end. They're the ones who adapted to the middle. The dollar is not dying. It's aging. And like every reserve currency before it, its decline will not be announced. It will be measured in basis points, in reserve shares, in purchasing power, in silent reallocations on central bank balance sheets, not in speeches, not in wars, not in revolutions, in spreadsheets. The pattern is already visible. The question is whether you'll recognize it in time.